Hi, welcome to Let's Talk Bonds, a fortnightly podcast from INR Bonds. I'm Arjun Patsati. And with global bond yields spiking, there are fresh jitters in the global markets and also in India. I mean, in terms of what could be the potential impact of the new spike in global bond yields on Indian markets and investors. The rise in global bond yields have now pushed the rupee down to below 83 to the dollar, and it's looking to go towards record lows. The 10-year GSEC government bond yield is also rising, and clearly there are some worries on what could be if this continues further. Now, can all this really have a very bad repercussions on the country? In India, has seen many effects of global bond yields rise over the past many years, especially in the 2012-13 Eurozone crisis, then the US Treasury yield rise on Fed withdrawal of accommodation, and all that had a temporary effect on the markets in India. But then again, it went back normalized. But on an overall basis, the effect was that the interest rates did reset higher and the rupee did reset lower. And that could also be a possibility as we go along. But before we continue with the impact of global bond yield spike on the Indian markets and what investors and financial advisors should look at, um, the best place for financial advisors is INR Bonds Partner Portal, where they can see the best bonds available for investments for their clients in very uncertain markets. And again, most information transparency and the easiest of investment processes. Log into inrbonds.com, sign up as partner, and transact through our platform, SEBI registered platform uh, now. And investors looking for and advisors looking for curated list of bonds can download our app, Quick Invest by INR Bonds, for curation for the list of curation bonds to ease up their investment decision making process. Again, with the most information and the easiest of in-app investment processes. Download the app now on iOS and Android. Bonds do carry interest rate risk. Prices can go up and down. Credit risk, the risk of default, and liquidity risk, where the impact cost of buying or selling can be very high. Investors and advisors should be aware of this fact before investing on INR Bonds platform, and read our terms and conditions carefully before investing in bonds. Going back to the global bond yield spike. So suddenly you have seen sharp rise in treasury yields. The markets did think that after the US 10-year touched 4% went up to 420, and it came down all the way back to less than 3.5%, that maybe the sharp rise is over, and the Fed after a heavy duty rate hike spree, where they've taken the Fed funds rates to over 5% after a long time. And again, sounding um, very cautious and hawkish, though the pace of rate hikes can be slower. And investors did think that, and markets did think that maybe we have seen the last of the spike in global bond yields. Similar was the case with Eurozone and other parts of the world. But with having said that, central bankers are still very wary of inflation. uh, they have they are sounding more hawkish, and not even though the pace of rate hikes may slow down, they are clearly worried about the long-term structural impact of inflation, and they want to prevent a long-term inflation spike in their economies. Hence the cautious tone and the guidance for as either more rate hikes, or watching data to make sure that inflation is not spiking up. So all this is again pushing up global bond yields, and also you have the factors of global banks facing the issue of rising bond yields on their in their portfolios and the business, and the rating agencies are threatening to downgrade global banks' ratings. But again, markets are way ahead of the agencies. And but having said that, to looking at the equity markets and looking at global economies in terms of macro data, apart from bond yields and inflation, there does seem to be a very strong traction on the economic front itself, which is something that um, is boding well for the markets. And because of the strong economy, maybe the markets could see a soft landing. That is, high bond yields could not may not have a very strong disruptions on global markets. Coming back to India, India did see that the 10-year G-Sec yield touched 7.5 as inflation spiked, but then again came down, and RBI did pause for a couple of policies, and that helped the 10-year G-Sec yield come down to closer to 7.1% and below. But then it didn't last too long at these levels, and it has gone back again to over 7.2% levels. India also saw the rupee stabilizing around 82 to the dollar after crossing 83 to the dollar. And for a while, there were very strong flows, equity flows from global investors. And that was also looking positive. So, all put together, where India did see a stable rupee, inflation down, and G-Sec yields off from highs. But this seems to be reversing now with the sudden spike in global bond yields. Rupees gone back to below 83, and 10-year yields are rising. RBI has also, while not cut already hiking rates, they have impounded money from the system by raising the incremental CRR, and that is preventing too much of money going into the economy at cheap levels. But at the same time, uh, the markets are still, equity markets are still at record highs. Corporate performance has been very good. Lenders are seeing very strong traction across banks, NBFCs, microfinance, and this and many corporates um, are seeing good demand, raising capacity. Uh, uh, Everything put together, it does look as if there is a strengthening economy rather than facing the impact of higher interest rates. And will this continue? Now, that's a big question to ask, whether it's inflation driven, and how can, whether maybe a sudden, maybe a continuous rise in global bond yields can impact the rupee and reverse foreign flows. Uh, without all these are possibilities, but at this point of time, it doesn't look um, as if that can have a very bad repercussions on the Indian markets. But one has to be watchful. So investors and advisors need to be careful. Maybe if they have been taking excessive risk, can tone it down. Um, have a more balanced portfolio with bonds and equities rather than waiting towards very high risk assets. Um, Look at fundamentals of each investment as you go along. Um, the question is that now whether the sudden spike in global bond yields can have a sharp impact, temporary or short term, in the market. A good possibility is there, and investors have to be braced for this kind of impact. But having said that, the markets could stabilize and again climb back given the strength of the economy. INR bonds has been listing out all the bonds that are available in the market. So right from AAA bonds at say 7.5 to A bonds up to all the way up to 13%. Each bond depending has its own characteristics. Investors and advisors do have to do their own due diligence to look at the investments they want to make. But the opportunities to invest are pretty high in the bond market, and investors can earn anything upwards from 7.5 or 9%, even 9%, or even up to 13% or even higher if they have the choose the right investments and do the due diligence correctly, and or take the advice of advisors who have done very strong due diligence for the investors. Thank you very much for listening in. Do not forget to sign up for all our podcast channels, and um, do download the app Quick Invest Buy in Our Bonds for looking at the best and investing in the curated list of bonds.